Imagine two friends. One of them is named Jake. Every month, Jake invests $1,000 into dividend stocks. He buys famous companies, dividend ETFs, and even a few high-yield funds. Every few months, money starts flowing into Jake's account. A small dividend payment at first, then a bigger one. Then, year after year, that number keeps growing. Jake feels like he is building passive income. He looks at his account and thinks, "I'm winning." The other friend is named Marcus. Marcus also invests $1,000 every month. But Marcus does not pick individual stocks. He does not chase dividends. He does not check yields. He simply buys a low-cost S&P 500 index fund, something like VU. Every month, he buys. Then he leaves it alone. No big dividend notification. No cash flowing into his account every quarter. Just one number quietly growing on a screen. From the outside, Jake looks like the smarter investor. Jake has cash flow. Jake has a story to tell. Marcus looks boring. But in investing, the thing that makes you feel like you are winning is not always the thing that makes you richer. And when you look at the numbers after 30 years, the result can make many dividend investors think twice. The first problem is that many people misunderstand dividends. They think dividends are extra money. They think it is like a company giving them free cash, like a small reward for being a shareholder. And on the surface, it feels that way. Money lands in your account. You did not sell anything. You did not work for it. You simply owned the stock, and the company paid you. That feeling is powerful. It makes dividends feel like real passive income. It makes people believe they are receiving money on top of their investment. But the truth is not that simple. When a company pays a dividend, the value of that dividend does not appear from nowhere. It comes from the company's own value. And when that money leaves the company, the stock price usually adjusts downward by roughly the same amount. Here is a simple example. Imagine a stock is trading at $100. Then the company pays a $2 dividend. After the dividend is paid, the stock may adjust to around $98. You now have $2 in cash, but your stock is worth about $2 less. So you did not magically become $2 richer. You simply moved $2 from one place to another. Before, that value was inside the stock. Now, that value is sitting as cash in your account. That is the part many investors never think about. They see the cash arrive, but they do not notice the value leaving the share price. So the dividend feels like income, but in many cases, it is really part of your own investment being handed back to you. And this is where the danger starts. Because once that dividend is paid to you, it can become taxable income, even if you do not spend it, even if you reinvest it immediately, even if your plan is to keep building your portfolio for the next 30 years. The tax system may still treat that dividend as income in the year you receive it. That means part of your compounding machine can get interrupted every single year. You receive the dividend, you feel good. You reinvest it. But a portion of that money may already belong to taxes. This is why dividends can be emotionally satisfying but mathematically expensive. They give you something visible. They give you a notification. They give you a feeling of progress. But they do not always give you more wealth. Because wealth is not built by how often money lands in your account. Wealth is built by how much money stays invested, keeps growing, and compounds over time. A dividend can feel like a reward, but it is not magic. It does not automatically make your portfolio bigger. It only changes the form of your wealth, from stock value into cash. And sometimes, that cash comes with a tax bill attached. Now let's look at the bigger problem. Taxes. Jake receives dividends regularly. Every few months, cash appears in his account. And because of that, he feels like his portfolio is working exactly the way it should. The money arrives, the number gets bigger, the income feels real. And in Jake's mind, this becomes proof that the strategy is working. But there is a hidden cost that Jake does not feel immediately. Every year, part of those dividends can be taken away by taxes. And this is where dividend investing starts to become more complicated than it looks. If Jake receives qualified dividends, the tax rate may be lower. That is the better version. But if Jake owns REITs, high-yield funds, or dividends that do not qualify for the lower tax rate, those payments can be taxed like ordinary income, the same way a paycheck is taxed. That means the dividend that felt like passive income may come with a tax bill attached. And this creates something called tax drag. Tax drag is simple. It is the invisible force that slows down your portfolio. It does not destroy your wealth in one obvious moment. It does not feel like a market crash. It does not look like a big mistake. It just slows your growth a little bit every year. And that is what makes it dangerous. Because in 1 year, the difference may look small. Maybe your portfolio loses 0.5%, maybe 1%, because of taxes, fees, and lower efficiency. That does not sound serious. Most investors would ignore it. Jake would probably ignore it too. Because his dividends are still coming in. His account is still growing, his portfolio still feels successful. But long-term investing does not punish you all at once. It punishes small leaks that keep repeating. 1 year of tax drag may not matter much, but 20 years of tax drag is different. 30 years of tax drag is completely different. A small drag repeated for decades can turn into a massive gap. This is what Jake does not see. Every time he receives a dividend, he feels like money is being added to his life. But every year, a portion of that money may be pulled out of his compounding machine. That money could have stayed invested. It could have kept growing. It could have created more growth on top of growth. But instead, some of it is removed early. Marcus has a different situation. Marcus buys a low-cost index fund. He does not receive large dividend payments every quarter. He does not get the same feeling of cash flow. His strategy looks boring. But most of Marcus's gain comes from the value of the fund going up over time. And if Marcus does not sell, he usually does not have to realize most of that gain yet. That means more of his money can stay inside the portfolio. More of his money can keep working. More of his money can continue compounding year after year. Jake receives money regularly, but part of that money may be taxed regularly. Marcus receives less visible income, but more of his wealth can remain invested. And that is why the strategy that feels like it is creating money can sometimes build wealth more slowly. Because the goal is not just to receive cash. The goal is to keep as much money as possible working for as long as possible. And taxes can quietly decide how much of your money actually gets to stay in the game. The most dangerous part of dividend investing is not only in the numbers, it is in the emotions. Because when Jake sees dividend money flowing into his account, he feels safe. He feels like something real is happening. He feels like his portfolio is finally working for him. Every payment feels like proof. Every notification feels like progress. Every quarter makes the strategy feel more powerful. And that feeling is hard to ignore. Jake is not just looking at an investment account. He is looking at what feels like passive income. Money arrives without him selling anything. Money arrives without him doing extra work. Money arrives while he sleeps, while he works, while he lives his normal life. So in Jake's mind, this becomes more than a strategy. It becomes confirmation that he is doing the right thing. The dividend checks keep coming. The annual income number keeps rising. And because of that, Jake starts to believe he is winning. But this is where the trap begins. Jake is not always comparing his strategy to the best alternative. He is usually comparing his portfolio to itself. He looks at last year, then he looks at this year. And from that angle, everything looks great. Last year, his portfolio paid him $2,000 in dividends. This year, it pays him $3,000. Then one day, it pays $5,000, then $10,000. Looking at those numbers, almost anyone would feel good. It feels like progress. It feels like income. It feels like financial freedom, slowly becoming real. But there is a problem Jake does not see. A strategy can improve compared to its own past and still underperform another strategy. Jake sees his dividend income going up, but he does not see the opportunity cost. He sees cash flow, but he does not see the growth he may have given up. He sees money arriving in his account, but he does not see how much larger the portfolio might have been if. That is the psychological trap. Dividends give Jake something visible. They give him something easy to measure. They give him something that feels like success. But visible income is not the same thing as maximum wealth. Cash flow can make an investor feel rich, but total return is what actually builds wealth. A portfolio can pay you every quarter and still leave you with less money after 30 years. A strategy can feel smart in the moment and still be less efficient over time. That is why dividend investing can be so emotionally powerful. It gives you constant proof that something is happening, but sometimes that proof hides the bigger picture. Jake feels like the dividend checks are showing him the truth, but they may only be showing him one part of the truth. They show the cash coming in. They do not show the taxes paid. They do not show the loss compounding. They do not show the better return that might have happened somewhere else. And over a long enough period of time, the difference can become enormous. Because the goal is not to feel smart every quarter. The goal is to build the most wealth over decades. And sometimes, the strategy that feels the most rewarding today can quietly make you less wealthy tomorrow. Now let's look at the long-term result. Jake and Marcus both invest $1,000 every month. They both stay consistent. They both keep investing for 30 years. But the final result is not the same. After 10 years, Jake has about $185,000. Marcus has about $205,000. At this point, the gap is only around $20,000. That is not small, but it does not feel shocking yet. And because Jake is still receiving dividends regularly, he still feels like he is on the right path. The money keeps arriving, the dividend checks keep growing, the strategy still feels good. So Jake does not feel behind. He feels confident. But time keeps moving. After 15 years, Jake's portfolio has grown to about $325,000. Marcus's index fund has grown to about $380,000. Now the gap is about $55,000. That is no longer just a small difference. But Jake may still not notice it emotionally because his portfolio is still growing. His dividend income is still rising. His account still looks better than it did last year. And that makes him feel like the strategy is working. Then after 20 years, the gap becomes much harder to ignore. Jake has about $510,000. Marcus has about $620,000. Now the difference is more than $100,000. $100,000. Not because Jake stopped investing. Not because Jake was careless. Not because Jake gave up. Jake kept investing every month. Jake kept reinvesting his dividends. Jake stayed disciplined. But discipline alone does not always erase the cost of an inefficient strategy. And after 30 years, the difference becomes very clear. Jake ends up with about $1.41 million. Marcus ends up with about $1.78 million. That is a gap of roughly $370,000. $370,000. That is not a tiny difference. That is a house. That is years of living expenses. That is money Jake never felt himself losing. And that is the most dangerous part. Jake did not lose because he was stupid. He did many things right. He invested consistently. He stayed patient. He reinvested. He followed a plan. But his strategy had too many small leaks. A little bit of tax every year, a little bit of higher fees, a little bit of lower return, a little bit more sector concentration, a little bit less exposure to the companies driving the fastest growth. Each one looks small by itself. None of them feels dramatic in a single year. But when those small leaks repeat for 30 years, they do not stay small. They compound. They grow. They create a gap that becomes larger and larger over time. That is why long-term investing can be so unforgiving. The mistake does not always look like a crash. It does not always look like panic selling. It does not always look like buying the wrong stock at the wrong time. Sometimes the mistake looks harmless. Sometimes it looks responsible. Sometimes it even feels smart. But if a strategy leaks money every year through taxes, fees, lower growth, and missed opportunities, time will expose it. Because in long-term investing, what destroys wealth is not always one big mistake. Sometimes it is a small mistake repeated for too long. The reason Marcus wins is not because he is smarter than Jake. In fact, Marcus does less. He does not pick individual stocks. He does not search for the best dividend companies. He does not try to guess which sector will win next. He does not chase high yields. He does not spend hours looking for the perfect income strategy. He simply buys the whole market through a low-cost index fund. And that simplicity becomes his advantage. Because in investing, simple does not always mean weak. Sometimes simple means fewer mistakes, fewer fees, fewer taxes, fewer decisions, and fewer ways to damage your own returns. An index fund gives Marcus several advantages at the same time. It has low fees. It gives him broad diversification. It does not require constant trading. It does not force him to choose individual winners. And in a taxable account, it usually creates fewer taxable distributions. That means more of Marcus's money can stay inside the portfolio. More money can keep growing. More money can keep compounding. And over 20 or 30 years, that matters a lot. Marcus also has more control. When he needs money in the future, he can choose how much to sell. He can choose when to sell. He can manage his capital gains more carefully. He is not forced to receive income at a time when he may not need it. Jake is different. Jake receives dividends whether he wants them or not. The cash arrives automatically. And when the cash arrives, taxes may arrive with it. That is the hidden problem. Dividend income feels convenient. But in a taxable account, convenience can become expensive. Jake may receive money every quarter, but Marcus may keep more money working for longer. And that is why index funds are often more efficient in taxable accounts, especially for younger investors, especially for people still building wealth, especially for anyone with a 20 or 30-year investing horizon. Marcus does not get the emotional reward every quarter. He does not get the same exciting feeling of cash flow. He does not see dividend checks constantly landing in his account. His strategy looks boring. But Marcus has something more important. A growth machine with fewer leaks, less tax drag, less fee drag, less complexity, less need to make the perfect decision again and again. Jake's portfolio feels active. Marcus's portfolio feels quiet. But quiet does not mean weak. Quiet can mean efficient. Quiet can mean disciplined. Quiet can mean more of your money stays invested long enough to compound. And that is the real lesson. In investing, boring is not always a disadvantage. Very often, boring is the advantage. This does not mean dividend stocks are bad. Dividends still have a place. They can be useful, they can be comforting, and in the right account, at the right stage of life, they can make sense. If you hold dividend stocks inside a tax-advantaged retirement account, like a Roth IRA or a 401k, the annual tax problem can become much smaller. That changes the math, because one of the biggest problems with dividends in a taxable account is that they can be taxed every year. But inside the right retirement account, that tax drag can be reduced or removed. So dividends are not the enemy. The problem is where you hold them, why you hold them, and whether you understand what they are really doing. For retirees, dividends can also have real value. If someone is no longer working and needs steady cash flow, dividend income can feel more stable. It can make retirement feel less stressful. It can reduce the emotional pressure of deciding which shares to sell every month. And for some people, that matters. Because investing is not only math, it is also behavior. If receiving dividends helps an investor stay calm during a market crash, that psychological benefit has value. If dividend payments help someone avoid panic selling when the market falls, then dividends may help that person stay invested. And sometimes, staying invested is more important than having the mathematically perfect strategy. But this is where the distinction matters. Dividend stocks can be useful, but they should be understood correctly. They can be a supplement. They do not always need to be the core of the portfolio. For most people who are still building long-term wealth, a more reasonable strategy is to use low-cost index funds as the foundation. That foundation gives you broad diversification, lower fees, better tax efficiency, less complexity, and a higher chance of staying invested for decades. Then, if you like dividends, you can add a smaller dividend allocation in the right account. Especially in tax-advantaged accounts, where the annual tax drag does not hurt you the same way. That is a very different idea from building your entire wealth plan around dividend income. Because the real trap is not dividend stocks. The real trap is believing that passive income matters more than total wealth. The real trap is thinking that money arriving every quarter automatically means you are winning. But the goal is not simply to see cash flow. The goal is not to receive more notifications. The goal is not to feel rich every few months. The real goal is to have more wealth after 20 or 30 years. And sometimes the person who wins the most is not the person receiving the most dividend alerts. It is the person quietly buying index funds, month after month, year after year, without showing off, without making the strategy complicated, without chasing the feeling of passive income. They simply keep investing. They keep the costs low. They let the money stay in the market, and they let time do the hardest work. Because in the end, investing does not always reward the strategy that feels the most exciting. It often rewards the strategy that keeps more money working for longer. And sometimes the quietest portfolio becomes the most powerful one.